Good day, investors. In this video, we will take a closer look at SoFi stock, ticker symbol SOFI. SoFi stock has dropped significantly, now trading in the mid $15 range, down over 40% from recent highs. But here's the interesting part. The business itself is actually performing very well. So the big question is this a broken stock or a massive opportunity? In this video, we're going to break down the latest financials, the revenue growth, the fundamentals, and ultimately answer the key question: is SoFi stock a buy right now at the current valuation? But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. Thank you very much. So SoFi is essentially a digital financial platform that offers everything in one place, including banking, loans, investing, and credit cards. The goal is to become a one-stop shop for your finances, where users can manage their money, borrow, and invest all within a single app. And by offering multiple products to the same customer, SoFi can increase engagement and grow revenue over time. Now, when we take a closer look at their recent financials, this is where things start to get really interesting, because SoFi is actually showing very strong growth across all key metrics. Revenue has grown from around $1 billion in 2021 to approximately $3.6 billion in 2025, which is a significant increase over just a few years. At the same time, adjusted EBITDA has expanded to over $1 billion, with margins improving to around 29%, showing strong operating leverage. And perhaps most importantly, the company has now transitioned into consistent profitability, generating roughly $480 million in net income last year and continuing to scale earnings. SoFi is also shifting towards more fee-based, capital-light revenue, which is a key part of its long-term strategy to improve margins. As we can see on this slide, fee-based revenue has grown from around $260 million in 2021 to over $1.5 billion in 2025, which is a massive increase. And as a result, it now makes up roughly 43% of total revenue. This is important because fee-based revenue is typically higher margin, more stable, and less capital intensive compared to lending. So over time, this shift could make SoFi a more predictable and scalable business with higher quality earnings. Now, when we look at the margins, we can clearly see that these investments are starting to deliver results. As we can see, despite continued reinvestment, SoFi has still been able to expand its EBITDA margins from around 9% in 2022 to nearly 29% in 2025. And this shows that the business is scaling efficiently, even while continuing to invest for future growth. Now, another very important metric to look at, especially for a company like SoFi, is something called the Rule of 40. This is a key benchmark used in growth companies, where you combine revenue growth and profitability to measure overall performance. And as we can see on this slide, SoFi has consistently performed very well on this metric. In fact, the company has exceeded the Rule of 40 for multiple years, with scores often in the 50 to 70 range, and in the most recent quarter it was around 68, showing solid overall performance. Now, beyond just growth and margins, it's also important to look at the actual returns the business is generating. And this is where SoFi's progress becomes even more visible. As we can see here, earnings per share have improved significantly, moving from around -$1 in 2021 to approximately 39 cents in 2025. At the same time, tangible book value has increased from about $3.2 billion to nearly $8.9 billion, showing strong value creation as the company scales. And when we look at return on tangible common equity, we can see a clear improvement as well, moving from around -11% to roughly 8% in 2025. And this is a key signal that the business model is starting to mature and become more sustainable over time. And when we look at user growth and product expansion for SoFi, we can clearly see strong momentum. As shown here, the number of members has grown from around 3.5 million in 2021 to over 13.6 million in 2025. Which is a very strong increase. At the same time, the number of products has expanded from about 5.2 million to over 20 million. And what's important here is that both metrics are growing at around a 40% compound annual growth rate. This shows strong demand for SoFi's platform, but also increasing engagement as users adopt multiple products, which leads to higher revenue per user and stronger long-term profitability. Now, when we zoom out and look at the bigger picture, this is where SoFi's business model really starts to stand out, because the company is building what they call a financial services productivity loop. In simple terms, the idea is to bring users into the platform with one core product, and then expand them into multiple products over time. For example, a customer might start with a loan or a savings account, and then gradually adopt investing, credit cards, or even crypto. And as users adopt more products, their engagement increases, and so does their lifetime value. At the same time, SoFi benefits from lower customer acquisition costs because it's much cheaper to sell additional products to existing users than to acquire new ones. This improves unit economics and helps drive higher margins over time, while also strengthening the brand as users become more integrated into the ecosystem. So what you end up with is a powerful flywheel, where more users lead to more products, higher revenue per user, and stronger long-term growth. Now, another key growth driver is SoFi's loan platform business. The company recently announced over $3.6 billion in new partnerships, including a deal with a global bank for over $1 billion, a $600 million agreement with a financial services and insurance group, and up to $2 billion with a major private asset manager. What SoFi does here is originate loans on behalf of these partners, earning fee-based income while retaining servicing rights. And in total, the company secured over $10 billion in commitments in 2025 alone, which highlights strong and growing demand for this business model. Now, when we look at price targets from stock analysis data, we can see that analysts are still quite bullish on the stock. The average price target sits around $25.7, which represents a potential upside of roughly 68% from current levels. Looking at the median estimate, it's around $27.5, implying an upside of about 80%. And if we go to the more bullish end, the highest price target is $37, which would represent a potential upside of over 140%. And when looking at the stock data from stock analysis, we can see the current setup more clearly. The stock is currently trading at around $15.27, giving it a market cap of roughly $19.8 billion. At the same time, the forward PE is around 25, which is relatively reasonable for a company with this level of growth. And importantly, the stock is down over 40% over the past 3 months, which could suggest a potential buying opportunity as the valuation has come down while the fundamentals remain strong. So when we bring everything together, I think SoFi presents a very interesting investment case at current levels. On the positive side, the company continues to execute well, with strong growth, improving profitability, and new monetization drivers like SoFi Plus and its expanding loan platform business, including over $3.6 billion in new high-margin deals. We're also seeing continued user growth, a push into crypto, and strong app engagement, all of which support long-term expansion. So fundamentally, the business is clearly moving in the right direction. However, there are still risks to consider. In the short term, market trust remains weak, and the stock could continue to be volatile due to sentiment and short pressure. So in my opinion, SoFi is a high-risk, high-reward growth stock, but at the current valuation, it could represent an attractive opportunity for long-term investors if the company continues to execute. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming investing videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching, and happy investing.